Statement of cash flow. As we discussed earlier in the classroom, corporations or companies, any company, can spend and receive cash from three sources: from operation, from investment, and from financing activities. Today I want to focus on cash flow from investing activities and cash flow from financing activities, and also cash flow from operating activities. The cash flow from operating activities, I'm going to discuss the indirect method. There are two methods to prepare cash flow from operation: direct method, which we discussed in the classroom, and the indirect method. The direct method is recommended by FASB, but the indirect method is the one that most corporations use in preparing their cash flow statement. So let us start. Cash flow from investing activities. We've discussed in class that the investing activities are three: loans that a corporation makes to others, and anytime a corporation lends another company, the journal entry will be debit, note receivable, credit cash. And you remember, when we credit cash, we're reducing our cash. That's the cash outlay or the cash outflow. The second one is investing in marketable securities. When a corporation purchases stocks in another company, that's an investment. The journal entry, if let's say Microsoft purchased Netflix stocks, is debit marketable securities, $10,000, credit cash, $10,000. So there is a cash outlay here because we purchased stocks. We paid cash. If the corporation sells the marketable securities, the entry will be debit cash and credit marketable security, that is cash received from sales of stocks. And the last one is the purchase or the sale of property, plant, and equipment. When a corporation purchases a building, the entry is debit a building, credit cash. That's a cash outlay or a cash outflow. When a corporation sells a building, that is a debit to cash and credit building. That's a cash inflow. So, anytime you debit a building, it means you are purchasing the building, yes? And the debit is always at cost. So if I tell you Microsoft purchased a building for $100,000, you all know at this point that Microsoft should debit the building at $100,000. And you know that the credit to the building account is the sale. So if I say Microsoft sold this building that they originally paid $100,000 for $120,000, what would you credit? I would like you all to write that T account on a piece of paper. On the T account, you're going to have a debit of $100,000. That's the cost when I purchased the building. What should be the credit side when I sell the building? What's the credit amount? I said I sold the building for $120,000. Would I credit $120,000? If you look at the T account, and if you do so, the net will be credit $20,000. But this is a building, and buildings do not have a credit balance because they're assets. And we've learned in Accounting 1050 that when we sell a building or an asset, we have to remove it from our general ledger at cost. So I have to credit $100,000. Then where do we put the $20,000? So I'm going to repeat the scenario again. I purchased a building for $100,000 and I sold it for $120,000. Where should we put this $20,000? If you're thinking that it's a gain and it should go to the income statement, then your answer is correct. So remember, when you sell a building, you credit the building general ledger account at cost, not at the sale price. And the difference between the cost, which is $100,000, and the sale price, which is $120,000, the $20,000 will appear as a gain on the income statement. So let's look at the second point now on this slide. However, credit entries in asset accounts represent cost of the assets sold. Yes, of course, it represents the cost. If I purchase a building for $100,000, I will debit $100,000. If I sell the building for $1 million, I would still have to credit the building for $100,000 to remove it from my books to make that building account zero because I no longer have it. But if I sell it at $1 million, $900,000 will appear on my income statement as a gain on sale of a building. So if a question ever tells you there is a credit to an equipment of $50,000, after this short discussion, you should know that this credit to an equipment for $20,000 is not a sale price. It's just a credit to the cost. So what's the sale price? You have to go to the income statement and check. Was this equipment sold at a gain? If it was sold at a gain of $5,000, then the sale price was $25,000. If the equipment was sold at a loss of $6,000, then that equipment was sold for $14,000. That's the cash received. And that's the last point. To determine the cash proceeds from these transactions, you need to adjust the amount of the credit entry, because the credit entry is only the cost of your equipment, by adding gains that appear on the income statement, gain on sale of the equipment, or subtracting the loss on sale of your equipment. So let's look at this example here. It says that when we were analyzing the ledger for marketable securities, so think that you have a T account for marketable securities, or write that down, there was a $65,000 debit. What is a debit in a marketable security means? A debit in any asset account, a fixed asset, a marketable security, an inventory, it means that we've purchased, yes? So the first thing you have to do when you're preparing your cash flow from investing activities is say, payments for the purchase of marketable securities, or purchases of marketable securities. How much did we pay? Cash, $65,000. Remember that our goal here is to determine how much cash I received from investing activities and how much cash I spent on investing activities. And in this case here, we have received $65,000. Sorry, we've paid $65,000, and that's why it's in negative. The second point, $44,000 in credit entries on the marketable security account. There's a T account for marketable security, and there's a $44,000 credit balance. We all know that we credit an asset when we sell the asset. But this credit is not the sale price. This credit is the original cost for the marketable securities. How much cash did I receive? It depends. If you sold it at a gain, you have to add the gain to the $44,000. If you've sold it at a loss, you have to subtract the loss from the $44,000. Again, the $44,000 is only your cost. Where can I find information about the gain or loss? In the income statement. So let's look at the income statement now. The income statement shows us that there is a loss of $4,000. So if you purchase stocks for $44,000 and a few months later you sell them at a loss of $4,000, this means that you've only received $40,000 from that sale. And that's what you see at the bottom in red. Proceeds from the sale of marketable securities, $40,000. That's it. That's how you prepare the cash flow from investing section for the sale and purchase of marketable securities. We also know about loans to others. If you look at your notes receivable T account, and everybody write your T account for notes receivable, and anytime you see a debit to notes receivable, you know that you've lent someone money. Debit, notes receivable, $17,000, and credit cash, $17,000. So if there are debit entries to the notes receivable account, you are going to add all these debit entries that you see in the T account, and you're going to say loans made to others, $17,000. Notice that $17,000 is a negative. Why? Because you're paying cash. Cash is going out of your a bank account or cash ledger. And anytime you see credit entries to notes receivable, when would I credit notes receivable? Now, that's not a fixed asset, okay? You will credit notes receivable when you collect your money back, when you receive the money. and the entry will be debit cash and credit notes receivable. So a credit to notes receivable is a collection of loan. So this one is simple. Loans made to others is simpler than fixed assets, because with fixed assets sometimes we have, and marketable securities of course, we never have a problem with the purchase because the purchase is the debit. Sometimes we might need to work more to determine the cash received from the sale of our marketable securities and fixed assets, because sometimes we sell at a gain and sometimes we sell at a loss. Let's look now at the planned assets. They purchased building for $200,000. When we purchase a building, we will debit building, yes, $200,000. They paid cash of $160,000. That's a credit. $160,000. And the remaining balance was financed by a long-term debt. So the entry will be debit building, $200,000, credit cash, $160,000, and credit notes payable, $40,000. In the cash flow statement, we are only interested about cash. I don't care that you have paid $40,000 for this building. When I'm preparing the cash flow statement, of course, I only want to know how much cash you spent on investing activities, how much cash you have received from investing activities. And I know that you spent $160,000 on the purchase of this planned asset. So if you look at the bottom schedule, purchases of planned assets, $200,000 minus the portion financed by notes payable, then that's what we care about. That's what we will use to prepare the cash flow statement. Cash paid for purchase of the planned asset, $160,000. This line in red is what will go to the cash flow statement. I don't care about the $40,000 notes payable, and I don't care that you've purchased a building. All what I want to know, how much cash did you use to purchase the building? Now, the previous slide was about the debit to building. Now let's look at the credit to building, which is similar to the sale of marketable securities. Again, a credit to building is always a sale, but it doesn't mean that the cash proceeds from sale is the amount of the credit. No, you have to look at the income statement to determine if this asset was sold at gain or at loss. If it was sold at cost, then yes, that credit is the cash received, only if it was sold at cost. But you rarely see this scenario. So if we're looking at the planned assets, we saw a credit of $44,000. That's a sale, but that's not the sale price. That's the cost of the planned asset. How much cash did we receive from the sale of this planned asset? Go to the income statement. The income statement says that this asset was sold at a gain of $31,000. Wow. If you've purchased an asset for $44,000, this is how much you've originally paid for it. And you're telling me now that you've made a gain of $31,000 on that asset, then I will understand that you sold it for $75,000. And that's what you see in red is what will go to your cash flow statement, especially in specific the investing activity section. Proceeds from sale of planned asset, $75,000. So this is how it looks. Investing activities. Purchase of marketable security. That's the debit to marketable security, $65,000. A sale of marketable security, $40,000. Remember, that's not the credit alone. This is the credit plus the gain on sale or minus the loss on the sale. Loans made to borrowers, that's all the debits that you can find on notes receivable ledger. Collections of loans, that's all the credits that you'll see on the notes receivable ledger. Purchase of planned assets, that's a debit to planned asset. And proceeds from sale of a planned asset, this is the credit to planned asset plus any gain or loss on the sale. So anytime you see the dollar amounts between brackets, that's a cash outlay, a payment, a reduction in cash. And anytime you see a positive number like the 40,000, the 75,000, it means that the company is receiving cash. When you add and subtract all these numbers, now we know that this company spent $115,000 on investing activities. Done. Now you should be able to go and answer your questions in your homework about investing activities. Financing. Let's refresh your memory about financing activities. We know that cash flow from financing activities consists of borrowing from others, and borrowing is in notes payable on my book. Anytime I borrow, I will debit cash and credit notes payable or bonds payable. So you know the credit to the notes payable account is the borrowing of money. And the debit to the notes payable account is when you pay back the loan. What else other than borrowing or notes payable and bonds payable? Stockholders' equity transactions, like what? The sale of a common stock, the sale of a preferred stock, the purchase of a treasury stock, and of course dividends. And I told you to circle the paid, dividends paid, okay? Because dividends received are considered operating, dividends paid, financing activities. So cash flow from financing activities are determined by analyzing the debit and credit changes recorded during the period in the related liability and stockholder equity account. Cash flows from financing activities are definitely easier to determine or calculate if you compare them to the investing activities, because investing activities, when you sell a building or marketable security, you have to determine the gain and loss and determine the cash proceeds from the sale of a building or marketable security. In financing activities, there is no gain or loss. The debit or credit changes in the balance sheet account usually are equal to the amounts of the related cash flow. What does that mean? It means if you credit notes payable by $50,000, it means you've received cash of $50,000, because anytime you credit notes payable, it means you're borrowing. If you debit notes payable for $10,000, it means you're paying cash of $10,000, because we pay notes payable and we debit it when we pay our notes payable. Remember, write like a small t account as I'm talking, so you understand. A credit to notes payable means we are borrowing cash. That's a plus to cash. A credit to notes payable. A debit to notes payable, that's we are paying back the debt. We're paying back the loan. That's a negative to the cash. Same thing with common stocks. Anytime you credit a common stock or you credit a preferred stock, it means you're issuing stocks. Cash is being received. That's a plus to cash. And anytime you debit a treasury stock, it means you are paying cash because you're repurchasing these shares from the market. You're pulling your shares out of the market and paying cash. Cash is in negative. So debit changes? Yes. When I debit treasury stock, that's a cash payment. When I debit notes payable, that is a cash payment. When I debit a bonds payable, that's also a cash payment. And that's how it would look like. Proceeds from short-term borrowing, that's basically all the credits to your borrowing, notes payable, and payments to settle your short-term debt or your borrowings. And that's a negative 55. And the payments represent the debit in your notes payable account. And pay attention. We are not talking about accounts payable here. We're talking about notes payable and bonds payable.